So progressive exposure starts with the concept of having a deliberately small, ineffective position. Deliberately. Why? Because when you're just starting out, let me say that again in English. Some people have a way with words. Take two. Some other people not have way. When you're just starting out, you don't know anything. You don't know your ass from a hole in the ground. So it makes no sense to me for you to put on your optimal position unless it's deliberately small, because you know that that's what you're doing to learn your craft. Then I would say you're smart, because the scaling up part is the easy part. That's easy. You just add more size. But if you're measuring and doing that with volatility and the growth of your account, you might be surprised to find that it takes quite a bit of time for you to be able to scale up and trade larger. Sometimes you need to go from one like E-mini or one NQ to two NQs. You might need to see a 40 to 60% move in your account balance in order to justify adding another instrument. But I have an easier way. Deliberately underlever your account at the beginning. Don't put on your optimum size all at once. This way, as you're watching the market, as you probably are, and unfortunately probably watching your P&L, which I told you not to do 1,000 times. I don't know why you don't listen. The P&L is not going to really matter. What you can do with that, though, is see how other people are behaving in the market with the damn instrument that you're trading at the same time that you're in it. You anticipated the move going up right when you got in. Did it happen or not? Why or why not? What's going on? How come there was no follow through? What could you see? Don't look at the indicators. It's not there. It's not going to ever be there. Those are always lagging. They can't tell you anything. They're like the newscasters who are, on the show. Market was off 300 today. Thanks. I wouldn't have known if I didn't tune in to your prescient stuff. Now, remember the journalists, too, not to harp on them. I haven't seen too many of them on TV, which is a nice way of saying I haven't seen any of them actually have any original thought. They have a network of people who are sending them research and smart things to say via email. Then those folks are parroting the stuff at a microphone or with a little lavalier thing clip on like this, as if they've invented it themselves. Their job is to convey information, the majority of which is not coming out of their own head. They might have a memory for certain things that have happened over time, but they're not really there to educate you, right? So you have to put that stuff in context. I find that financial television is largely useless. It's basically useless. There's not a lot, they speak about the obvious, but ultimately you're going to need to know where you're going to get your risk on and where you're going to get it off. You're going to need to know how much. Again, go back to the progressive exposure example and say, okay, well, now that I have the piece on, I can see that other people are looking to add to their positions or add for the first time. I'm going to add another contract. Now, this can be a micro contract. This can be another ES. It can be another 200 shares of NVIDIA or whatever you're trading. But at the beginning, if you underlever your account, you can eventually work into your optimal position size. And as you add, you do what Soros and Druckenmiller did, and many others, by increasing your average cost basis. Then you can calculate where your protective stop is, right? So you get used to adding to your winners right at the beginning. But the position size is so small, it's not going to mean a lot if you get knocked out. Right? Because you don't want to get used to, nor do you want to build a habit in and around taking small gains. You'll always be small. And remember, how can you tell if you're small? Well, if you look at what you've made on any given day or week and you divide that by 20, that's what you're making. That's how many hours you would have had to have worked in minimum wage to earn what you're earning. So you want to grow out of that as fast as possible. You don't want to make trading a blue-collar job. There's nothing wrong with starting out and being blue-collar, but trading is a spot where you can work hard and also work smartly, but then also geometrically increase your financial situation. You see what I'm saying? So at the end of the day, if you underlevel your account at the beginning, you'll really learn your craft. You can learn a feel for the market while the stakes are not that high. And this way, if your timing is off, who cares? You got a small piece on, right? So in what the MNQ is what, $2 a point? That's what I'm saying. Like, who cares, right? Whatever you make and lose, you probably had sushi dinner bills that were greater. That's not the point. If you don't want to work at a simulator and risk, $10 a trade doing that, this to me is the next best thing, with the added benefit that you're actually risking real money, right? So there's an emotional thing there that could work for you too. But when you add to your winners, you start to develop really good habits. Because then as the move starts to go underway, you can increase your cost basis, your average cost, and you could add 3, 4, 5, 6 times. It doesn't matter. Eventually, you can simulate and backtest if you want, right, for your particular trading style, and you can use a any number that you want to pick. ATR is certainly something that's out there, but a lot of these guys started trading long before ATR was even invented, right? So take it with a grain of salt. It's just another indicator. It's another way to take your pulse. So you can do that. You could also look at structure and say after the thing broke out, it traded up and then it started to consolidate. And I'm not talking about intraday consolidation. It might be daily charts. There might be several days where it consolidated and took a pause and then it broke out, at which point you buy more, you see? And then you can adjust your protective stop to account for now that you have 3 or 4 additions and know what your average cost is, right? The math will be the same, right? Because think about it. If I buy 100 shares of something at 10 and I buy another 100 shares at whatever it is, 16, I'll be a break even on the first piece and I'll have $600 of unrealized gain on my first risk unit. At the time I buy the 200 another 100 shares, I'll have 200 shares at 16. Now my average cost goes to 13, so that's $3 of unrealized gains times 200 shares. So the math still works out. Now you can figure out where to put your protective stop. At least you know where your break even's going to be. I always wanted to know what I was working for because I couldn't afford to work for $50 because the commissions were, I showed you on the damn live stream how having a 40% accuracy where I was making $450. I think the numbers were, the average winner was $450, which I'd make 40% of the time, and I'd lose $150, 60% of the time. If the math's right, I think you would basically make $90. But the commissions would eat that up. So there was no real gain on my account. Nowadays there's no commission, so it might be a little bit more meaningful for you, but you get, if you overtrade all, you could end up losing all your damn gains for the day, and then you have whatever 10 trades that you've put on and you've got no P&L. And to me, that's a mistake. I know some of you might feel differently because, again, you're already doing it, but this show is for the folks who are trying to figure it out. I'm not trying to give people who are already succeeding, the few of you that are out there in the short-term game, anything that's antagonizing. You just have to understand that you're terribly lucky. And my hat's off to you. The majority of people are not succeeding at this. They're failing at it. And that's what this show is for those people who are trying to figure it out to find a better model than the one they're actually doing. So, again, my hat's off to you if you're succeeding in any type of trading strategy. But given the fact that the marketers have unlimited resources to just say whatever they want, and then there's no real policing of that, you find out that people are getting stuck, and they're getting hurt. So another question came in from Iron Brow about a month ago, where bigger gains come from. That was the video. You don't look at charts, you look at the data. What data other than the price are you looking at when you're always telling us what price is telling you? Well, Iron Brow, what do you think price is telling you when you put your position on? To me, it's self-explanatory. Again, go back to the live stream and I showed you what I did. I went in every day and I looked at the open, high, low, close pricing, and then I conjugated that with my position and saw an emotional intelligence response as well as what was going on with my account. I needed to grow my account. When most of you are looking at trades, you're like, oh, I'm up 50% in the trade. But that doesn't really tell me anything about how you're growing your account, which is the thrust of what you should be doing. Your goal should be in and around having a process that you could multiply your account severalfold. No one cares about making 20% on a single position, right? Unless you've had half your money in the account. Then you could do the math and say, okay, this is how it moved my bottom line, right? So look at the data means look at what's the financial plan of your trading. What are you doing it for? What's the goal, right? You can't be trading and not have a goal. That to me is stupid, right? You need to know what you're doing it for. How is trading supposed to serve you? And then how are you interpreting the data that you're getting day after day, week after week? How do you know if you're making success or not? Because it's not necessarily what's the result of any one particular trade. It's what's the general tendency of your overall account. I knew guys that I started with on Wall Street. His guy's name was Mike, and he was an options trader. He would trade SPX, and he'd ramp his account up, and then he'd be like, yeah, this is great. And then he'd let his guard down, and then he would take bigger losses than he should have, and he'd end up flat to almost not making any money for the month after being up sometimes 20, 30% on his account. And so to me, that was because he didn't have a clear vision of what it was that he was trying to do. He was so focused on the trade at hand, right, that he didn't have a plan for growing his account. He didn't have a plan that said, okay, if I have $100,000 and I get to 130, I'm going to put my protective stop at a spot where I walk away. I'm still at $1.25, right? I'm going to risk 5K to stay in the trade because I don't know that it's not going to go to 150. And don't start with me. If you haven't done the back testing, you're talking shit. Show me the back test because you don't know. It's not 9 times out of 10 it pulls back. You don't know that. You don't know that at all. So know what you're talking about. Opinions don't matter. Not to me anyway. So if you find yourself in that spot where you're out of sync, coming back to the theme, the under leverage part of your trading could be massive because it can get you in sync with the market in a way that you're not going to really get blasted. Again, your job being not to lose. Your job is to play superior defense. You see what I'm saying? So once you get in the groove, once you start making money, you can invest your gains into your protective stop by adding more and then adjusting your protective stop to take into account what your new average cost is. And that, to me, is how you can build into it your optimal position and let the market do the work to start really growing your account balance, which is what the goal should be. Like this video, check out this one.